Future again with Ed Siddell, CEO and Chief Investment Advisor, EGSI Financial. Thank you so much for joining us this afternoon. Let's talk broad strokes. What's your take on the Fed's decision to cut rates by 50 basis points, especially given the perspective that most industry watchers expected 25? What's your take?
You know, we were expecting a 50 basis point cut a couple weeks ago, and we were actually looking at it saying, you know what, they'll probably wind up doing 25. So we weren't completely surprised at the move. But, you know, honestly, we realized that they basically had to, just because of all the debt that we have. I mean, this is, you know, when people call it a political decision, I'm kind of looking at it as a bigger picture, right? Not just from the economy, but also servicing of the national debt. So we expect them to lower rates another 50 basis points to as much as 75 by the end of the year, and, you know, at least another 100 basis points in 2025.
So then, let me ask you then, what do you make of, so the language used in the press conference by Powell was a recalibration, and he's often in the past saying they make decisions meeting by meeting. What is your reasoning behind what you're expecting through the balance of this year?
You know, I think the rest of this year is going to be pretty volatile, but it's going to finish on an uptick, because as they lower rates, you know, the market is going to excel. But I think the market growth going into next year, it's going to continue as long as they lower rates. But it could be short-lived. My biggest fear is that inflation, it is not going away. It's going to come back, and if we're not careful, you know, we could wind up in a situation like and repeat of the 70s. You know, as far as inflation and then having interest rates come roaring back. You know, I think the Feds are looking at this to refinance the debt, correct their balance sheet, you know, get it off of this 90 to 180-day turnaround for treasuries and refinance it longer term. Because right now, when interest rates were as high as they were, the second largest line item for our budget was servicing the national debt. I mean, it actually exceeded defense spending. So, you know, I think that's part of the near-term plan for the Feds. But again, you know, it's I'm concerned.
But do you really think that we would go back to the inflation levels, like the runaway inflation levels that we talked about, or that you just talked about with regard to the 70s?
We could. Absolutely, because we continue to spend. I just saw the numbers that came out last month. We spent over 400 billion. I'm sorry, we took in 400 billion in tax revenues, but we deficit spend 480 billion. So we more than double what we're taking in. And so at the beginning of the year, you know, we were overspending $1 trillion about every 111 days, and then it went down to about every 100 days. And now we're, you know, based on the numbers that I saw today, you know, we're well below 100 as far as the deficit spending. So we have to get that under control. You know, we also have to realize that, yes, we've added a lot of jobs, but a lot of that was to government. And really, that's inflationary by itself, because there's nothing being produced there. It's more of an expense center. And so to cover the cost of those jobs, you know, that's coming directly from revenue, which we don't have. So we have to deficit spend. So it becomes a vicious cycle. So we really have to get that budget under control. And if we don't, as we lower rates, typically what happens when we lower rates, not just on the country level, but on the consumer level, we all continue to overspend. So we need to make sure that we control it.
So many market participants are expecting that the Fed will achieve a soft landing. And it sounded like from the tone of the conference yesterday, it sounded like that was in sight. What's your view on that?
You know, it's a possibility. You know, we believe that we're kind of in a sort of a recession right now, going back to what we're talking about, public sector versus private sector. You know, the public sector has been growing. The private sector, we haven't added nearly as much jobs as what was originally reported, especially when the jobs report came out earlier this year, it was actually reduced by 818,000 jobs. And we have to remember that was on top of all the revisions throughout the last year, because every time we reported jobs, they revised it downwards 2 months later. So we have to make sure that we understand that going forward. So, when we're looking at this, we've got to make sure we're taking everything into focus. We can't just be myopic and focus on one thing. We have to look at the bigger picture.
We can't be myopic, you're right, but how can you say that with the say private sector recession, when you see, maybe there's certain pockets of weakness in different industries, but overall the job market has held up better. Yes, we've had a couple prints recently that weren't the best when you compare it to prints prior to that. But overall, the job markets, we had new data coming out today showing jobless claims were better than expected. So there's not as many layoffs happening. Where is that view coming from?
Well, we have to just look across the country. I mean, the savings rate, the average was 8.8. Now it's below 3%. The amount of consumer debt has more than doubled in the last couple of years. We've got all-time high credit card debt. We're starting to see deficiencies in credit card payments and as well as car loans. So, it really is a tale of two cities. You've got working class America who's been struggling over the last couple of years, and it's really the difference between Main Street and Wall Street. So, when I'm talking about a recession, people are feeling it all the way across the board. So it really comes down to spending. How can we get everything under control and make sure that the jobs that we're actually reporting on aren't second and third jobs? Because remember, a lot of the jobs that were being reported were in the service industry. And they were second and third jobs. They didn't have benefits. So people are going out and taking these other jobs to ensure that they have money left at the end of the month and they don't go further into debt.
Okay. All right. Thank you for that perspective. Really quickly, Ed, just if you could take a fine point on this. We're seeing markets hit all-time highs today off the back of the Fed's decision to reduce interest rates by 50 basis points. Is this rally that we're seeing sustainable in your view, especially given the perspective that you're speaking from now?
Short term, yes. I think we're going to see a lot of volatility. And again, as the markets like it when rates go down. So as long as they continue to lower rates, the market's going to continue to rally. But it's not going to last forever. And again, there's so many things that go into it. I think between now and the end of the year, even after the election, and it is not election contingent by any stretch of the imagination, I think the year is going to finish off positive. And I think it could be positive going into next year. As far as that soft landing goes, it all depends on what the Feds do and what the leaders in D.C. do.
All right, Ed Siddell, CEO of EGSI Financial. Thank you so much, Ed. Great insight.
Thank you.